Good morning from Newport, Rhode Island. We have an event up here that Mark's putting on today. I want to jump into this and really spend some time talking about the debt problem that exists in the world, and all the focus has been on growth and inflation and the war and the pandemic. But I think we have an issue that really needs to be looked at in more detail. So we're going to jump into that today. So I showed this slide last week, but I saw this quote from the former governor of the central bank, who's a professor at the University of Chile, and he's talking about the increase in debt in the world, and particularly what it's doing to the emerging market economies as one of the most important global developments in years, and also one of the main sources of risk. And I agree with that. I think that you have two things working against the emerging economies right now. One is the strength in the dollar, and two is the rise in debt that we're seeing around the world. And it's been pretty shocking. So let's just jump right into it. This gives you a look at the chart showing total debt, private and government, from back in 2000. And what you've seen is a growth in the debt, where we're now closing in on $300 trillion of debt on a $92 trillion global economy, give or take a couple trillion. So we're over three to one in debt. It's closing in on 350% of debt, but it's a threefold increase since 2000, and that is problematic. And as we wrote a piece several years ago called "Sending the Bill to the Kids' Table," and I think that's what we're doing with debt right now. We're creating a problem that you're going to be pushing debt onto future generations, for one, but you also are crowding out spending. And as we were talking about in the breakout session earlier this morning, governments are being forced to make choices with more limited resources, and interest costs are crowding out some of the debt. So this is a big issue, and it's a growing issue, and it's not an evenly an issue that everyone's dealing with in the same way. This is a look at it by country, and you can see Japan at the high end, and Canada up there, the US, but all the way down. And it's these are staggering numbers when you think about the percent of debt, but you also have to remember that not all debt is equal. A lot of the debt in Japan is between companies and inside their own economy with their pension plans and other areas. But other countries have big debt issues that are really becoming much more problematic, with their growth rates not being able to support that, how you're going to deal with this. Japan is actually one of the outliers of not raising rates. And this is, I think, one of the reasons why is when you have such a high debt load, raising rates just chokes off your ability to get out of the problem. So just to give you a quick view of the numbers, this is from JP Morgan, and they looked at a report from the the Institute of International Finance, and they, debt surged 42% globally in the pandemic, reached an all-time high in Q1 of last year at 366. It's come down this year, but you still have developed market leverage at a very high level. It's the highest it's been, at over 401, and a lot of that is the Japanese economy and the US and others. But you have these emerging market economies still with very high numbers at 267%. Japan and Singapore have been kind of at the forefront in the high debt area. Mexico, Argentina, and Indonesia are on the low debt side. I wouldn't say that that's a case to run to any of those countries necessarily, but it is interesting how divergent the views are. This is another look, and this is a problem that I think is going to be a growing issue for the emerging market and developing economies. Is they have debt growing at a very high rate, going one way with their as a percent growth and their as a percent of GDP, and then on the other hand, you have their growth rates not really going in the right direction. So that's a bad cross when you have growth going down and debt going up. And particularly when you look at the emerging market economies, generally have higher interest rates to begin with. And you're also seeing a lot of the inflationary pressures. I think the compounding problem right now is the US dollar strength, as a lot of their debts are in dollars. So servicing the debts becomes more expensive that way too. And that puts even greater strains on the governments at a time that they really can't afford it. Because when you have the food inflation and the energy inflation that's going on, you get a lot of unrest. And as we all remember, the Arab Spring is a big part of that, was an offshoot of the food crisis. And now when you combine that with food and an energy crisis, it creates a lot of social strain. And I think that is a big detriment to governments being able to effectively govern and solve the needs of the divergent needs of their population. So I think this is an area that is going to get a lot more attention. Right now, it's kind of being muted by the inflationary issues, but and the inflation concerns and the war and that's going on. But I think the underlying issues, we're going to be stuck with a debt hangover that needs to be reckoned with in some form. So the emerging economies have had 4 waves of debt over the last 50 years. The first wave ran from 70 to 89, and that was mainly Latin American countries and the Caribbean and low-income countries. And that was, we had the Brady bond issue and the debt crisis that we had. Then you moved into the second wave, which was a mainly East Asia Pacific, which was 90 to 2001. And we know what happened in that period. And then you had the third wave that kind of ran from leading up to the financial crisis after you had the reckoning from 2001. And then you got into, government stepped up and bailed out. And then you had the fourth wave of debt rising, which has gone on from 2010 forward. And this has been a problem, and it's going to challenge governments, I think, in material ways. They don't have the growth. Their prospects for growth are getting worse, not better for most of them, unless you're an energy exporter, and then it's, you got to get it while you can. You have growing deficits in these places. And when you look at the recent experiences of Turkey and Argentina with inflation running up and borrowing costs, Brazil raised their prime, I think, 11.5% this year. Their Fed funds rate went up 11.5%. I think you had Turkey with 75% inflation rates. This is not a good sign. And as we know, debt waves usually end very badly. And wouldn't be a surprise if we have some real fallout in the emerging markets from this. And usually it coincides with Fed tightenings. And this chart shows you kind of the waves that we just talked about and what happened. You had the Mexico crisis, then you had the peso and Russia's problem and others. So you've seen this evolve over time. This chart's just a great reminder of what happens when the Fed tightens, something usually breaks. And it's usually not necessarily in the US where that problem happens. So I think this is something we got to just keep in mind and not lose sight of as we're focused on the near-term issues of the war and the pandemic. So switching back to the US, this is a chart that I wanted to show because it gives you the yield curve for the US as of Friday, then it's as of a year ago in the yellow, and then where it was 2 years ago in the red. And this matters, and it matters a lot for a lot of the stuff that was talked about earlier today in terms of where we are. It matters for valuations across the board, but it also matters because we have a bill coming due. And this is a snapshot of the US economy from 1990, 2000, 2008, because I just wanted to show the starting point there, 2010, 2020, and where we are today. And I looked at gross domestic product, gross debt, debt held by the public, and our net interest, and what the rates were, prime lending and Fed funds at the time. And in 1990, we need to keep this in mind. We had a GDP of just about $5.8 trillion. We had debt of 3.2. Debt held by the public wasn't that high, but look at what our net interest was. It was only, $184 billion. I say only. We had a prime lending rate of 10%, and we had Fed funds at 8.1%. So just remember when you were getting your mortgages back then. If anyone who was getting a mortgage, I got one in '89. Not a fun time. You fast forward 10 years, and we've almost just shied about a 70% increase in the global in GDP for the US. Our debt grew about the same. But our interest costs only went up about $40 billion. And a big part of that was the prime rates came down and Fed funds came down a lot. So you started to have the interest rates coming down. Then we had the financial crisis, and that's where it started to explode. So we had a $14 trillion economy at the time. We had about 10 trillion in debt, but our interest costs were only $250 billion, so still manageable against that size economy. And look where Fed funds was down to 192 at that point. And then you see it dropping in 2010. We took it down to 0.19 on the Fed funds rate, but our debt now is almost doubled. And we have not grown GDP much in those 2 years. So we had a big step up in debt, 4 trillion growth in debt. And we only had a $300 billion increase in GDP. So not a great sign there. And then we move forward to 2020 when the pandemic, and you can see how it really ramped up. But I think the big concern that I have, and the thing I want to really highlight for everyone today, is we just had a jump in our Fed funds rate, and it's going to continue to go up with the next meeting, likely another 75 basis points. But we're now looking at debt of 360 interest cost of $360 billion. But I think if you revise that for the current Fed funds rate and where Fed funds are going, I think you're looking at a bill where the net interest for the government could be higher than our spending on defense, spending on healthcare from the government. And that is a problem because we have many issues to deal with in the United States. And if we're putting so much of our spend of what the government gets to net interest, it's going to crowd out the needs that we have for growth. So this is a problem, and this is a problem for policymakers, which is, and I think it's a problem for the people who believe in modern portfolio theory. I just think that the bill does come due, and while we can keep printing, you have to have buyers of your debt. And I think that's going to be a problem when our interest costs are so high and our GDP growth is not moving at a very great rate. So I think we have some real issues that we're going to have to deal with in the US on debt. I think global debt is an issue. I didn't touch on Europe, but I think the outlook for there cannot be spectacular right now. But I think there's other debt issues around the world that are worth mentioning. So just some takeaways here. Global debt to GDP is more than double where it was in 2006. It's triple where it was in 2000. So that's not a great setup for the global economy. We're having slowing growth with massive inflation, which I think is starting to peak. That people can argue with that. I think we are seeing in the US certainly a leveling off. I don't expect that's going to lead the Fed to be aggressive on lowering rates, but I don't think it's going to have them raise rates as much as as the market had been expecting, although market expectations are coming down more than the Fed's outlook. I think debt servicing expenses are going to limit the spending on other important initiatives. And I think that's going to create a lot of social stresses, not only here, but around the world. And I think that's, when you go back to the Arab Spring, it was a food inflation that was the driver for that. And I think you're going to see a lot of social unrest picking up. You're seeing it in countries right now. And what's going on in China is fascinating, right? They have a huge debt problem in real estate. And there's a big vulnerability there. And they're now having thousands of people, tens of thousands of people protesting on the streets, stopping their payments for properties that are being built. The developers need the money to continue to come in. So who's going to get stuck with the bill on that? And that's, I think, there's pockets of debt problems around the world that are vulnerabilities that could expand. So I think that we have an issue that is lost in the noise about the war and inflation, but the debt bill is going to come due, and how do you deal with that? So I think there's the big question, and this is the Japan question for decades now, is can we deleverage an economy without a full-blown crisis or a massive default or a massive debt jubilee where we forgive the debt, and who gets stuck with that? And at what point does debt become a bigger concern for the markets than inflation, and for policymakers than inflation, and how do we deal with it? So I'm going to stop there and open it up for comments and thoughts from the crowd. And I'd love if any of the folks from Asia or the emerging markets are on to share their views. So let me stop there. Yes, Andrew.
Just two quick questions. I'll let you just respond. One, we also have 3 times as much corporate debt as we had in in 2006 for the last debt crisis.
Yeah.
And the other thing is that what is the mechanism that we've never had the Fed be literally the government debt elephant in the room with the size of the balance, I'm sorry, the elephant in the room with rising rates.
Yep.
With the size of the Fed's balance unprecedented, we've never experienced this before. So you have a mechanism where money is coming off or going into the federal deficit, paying who?
To the Treasury.
The Fed, the Treasury Department.
Yep.
So I can't even get my hands around that mechanism. What's the impact of that?
Yeah, I think the impact of the shift between the Fed and the Treasury is not as much. We'll eliminate some of that with the QT that's going on. And the first stuff that comes out is the stuff that's not in the banking system, right? It's not in the system. It's sitting on the bank's balance sheets. It'll just revert back up, and that'll be a non-event for the economy. I think it's when you get past the first wave of the stuff that's not circulating and start cutting into what is in circulation, and you're going to slow down. You have to have a slowdown in the economy. I think it's a natural cause and effect of a debt buildup.
I was sort of focusing on the deficit impact when the government is basically paying itself. Interest.
Yeah, the money that they're paying themselves is a wash, right? So that's not a problem.
Sure, if that's the case.
It's generally a wash.
One side,
Yeah.
the other side, but then what?
Yeah, and then you just have a little bit of the cost of capital in between. I think it's when you start going below that and tighten below that you start pulling money out of the system. Yeah. Yeah. I think the other issue, though, that you raised is corporate debt is on the rise. And I think we're going to find as Buffett likes to say, who's swimming naked when the tide goes out, right? That's what you're going to find. And as people who've been on the calls regularly have known that I'm a big believer in there's a have and have-nots economy. And I think we're going to get a reckoning in the corporate world where the haves and have-nots will be quite clear. And I think that's one of the big advantages that the FANGs have that they don't get credit enough for, is their cash flows are so great that their ability to manage their own debt levels and make acquisitions is going to create an even further gap, which creates a policy problem when you get companies that have that size growing even bigger. And does that lead to a breakup? Whether it does or doesn't, they'll break them up and they'll still have a lot of cash. So they'll still be that much further ahead of everyone else. So I think that that's a big issue that's coming. And I think there's a real separation in returns coming out of that. And I think that makes it more of a stock selection market, whether it's public, private, doesn't really matter.
Makes sense.
Some questions in the chat or comments in the chat. Nope, none of them are worth discussing. Jack?
Steve, there are a multitude of factors, at least a large number, that you've just articulated. Some are historic, so they're part of past cycles, and some are unprecedented. And given the situation and given the depth of your knowledge, if you had a magic wand, what would you do in an overarching respect that can help attack or begin to solve the problems that you just described?
But
it's a magic wand, remember.
yeah, I would actually challenge the politicians to not try and solve all the problems that they're trying to solve at once, because we don't have the money for it. So I think you have to triage and you have to pick the most important problems and address them first. The problem with that is getting Washington to agree on the most important problems. For my seat, I thank Joe Manchin for slowing down everything right now, because I think the US needs to take a breather and think about what are the big priorities and what's the best way to attack the multitude of problems that we have, because there are too many problems to solve with the cash that's available. So we're going to have, you're going to have to run the country like you would run a corporation well, not the way you run a corporation poorly.
And therefore, it's interesting that Joe Manchin would be our hero of the moment, given.
I would just say, not everyone's.
Right. No. Well, particularly, there's an argument, particularly among those that are closer to him, that his behavior of late, last year or two, has been influenced largely by the base in his state, as opposed to broad considerations about the the state of human life and the world and so on. But nevertheless, the positions that he's taken, despite the stress that it's caused within his own party, may prove to be, actions that would chip away or diminish the problem.
Yeah,
Problems.
no, you're right. I think the hard part about politics today is you immediately go to that person's bias and say everything they're doing is based on, in Manchin's case, the coal industry. But if you step back and said what he really was concerned about with the next Build Back Better program was what Larry Summers has been saying for 2 years, which is we can't afford to spend more with what it will do for inflation and the deficit. And if we don't get those two under control, the rest of it doesn't matter. You won't get a green transition. You won't get all the other stuff you want. You can't solve all the social ills that the world's facing if you don't get your house in order. And I think that was a message that was sobering to a lot of people, but it's a message that I think people have to look past the ideology of, well, obviously he's against the green revolution and all that. And why would he be in favor of it? I think they know that their time is limited for the fossil fuel industry, might be less limited than everyone thinks, but the switch is going to evolve over time if we can afford it. So I think that focusing on the deficit and inflation was a very patriotic thing for him to do at a time that people had forgotten that those things actually matter. And now they're starting to realize that they do matter. So I think that's a way to look at what he's
So
doing.
you've now had 4 minutes to develop your magic wand plan. Anything beyond the prioritization that you just referenced?
I'm not smart enough to solve all the problems that this country has or the rest of the world has. I think you have to make good long-term decisions, not just go election cycles. And now it's 2-year election cycles. So it's not even, you can't get anything material going. And for all the criticism that people throw at China, and they make a lot of mistakes, the fact that they can take a longer term view and support strategically vital industries and have a plan for it and a detailed plan. It would be nice to see the US have a detailed plan for how you want to get there, not a wish list. In business, a business plan not written is just a wish. I think that's what the government has right now is a wish list.
So migrating to a different zone.
Yeah.
What is, if there's a collective view, what might be our collective view as to how and why, and whether the world should continue to stand by while a Hitler-like disciple impairs life on Earth, as is the case undertaken by Putin.
Yeah.
It was a novelty for a while. It's endured. The place is being destroyed. It's reminiscent of all prior wars. Yep. When innocent people and innocent buildings are toppled, and it continues to happen while we fuss about all these other topics of interest.
It gets the priorities. What's the biggest priority right now? And it's, I think it's the crisis in Ukraine is really driving so much what's going on. But I worry that Europe is now facing really significant issues. And can they stand in support, or are they going to start saying, well, the Donbass region isn't all, maybe if we can get past this, we wouldn't be saying that. Well, you might say it about some states in the United States, and some states in the United States might want out anyway. But I don't think we'd stand by and let, Texas or pick a state. I'm not going to get involved in the politics, Ohio, that, let that be, taken over by a foreign country. So I think you're on a key point is where does the politics trump economics, or where does economics trump politics? And I think
you've introduced another topic, which is Texas is a foreign country.
I understand. I thought you were going to say Ohio is.
Well, they want to be.
I think we're in a really awkward. We're just in one of those awkward spots where there are no good decisions. There are only the best of bad decisions that have to be made, and that's what happens in crises. And we're going to have to figure out. You're going to have real leaders, and unfortunately, right now in many of the countries, their leaders are on their way out, or been thrown out, or in the process of being thrown out, or approval ratings are historic lows, and you go on and on through the list. So where's the leadership going to come from? And I think that's the $1 million question. So The answer for me, Jack, to your original question was find the one good leader that can make the good decisions and bring the country together and move us forward. We need a, Reagan-like movement, or what Merkel did for a long time in Europe, was hold Europe together in a tough period. You need somebody like that to step up, and the current roster isn't there. So it's more of the same. So that's not going to be the answer. So I don't really have a better answer for you than that.
Would you use your magic wand on the energy, oil and gas?
I'm a big believer that we need to go green. I think you need to go green with the right cadence and tempo to get there. John Wooden, the basketball coach for UCLA, used to have a great line. He said, "Be quick, but don't hurry." And his idea for his players was, you got to move at a good pace, but you can't move too fast so you make mistakes. And I think that's what's happened in the energy transition so far. And I think vilifying the fossil fuel industry is a dumb move. And it's proven to be dumb by the results we're having right now. I think you have to get the best minds together to come up with the right solution, not the ideological one. And we just need to be practical, and we're not right now.
Steve, back to inflation for a second. Start with energy for a second. So 1970s energy crisis was started by a mere 3% shortfall in supply. The inelasticity of supply in the energy market is tremendous. With that said, today, as a percentage of GDP, we use about a third of the energy produced in GDP that we did back in the 70s. So in theory, the impact is less. With that said, we've been through a bunch of oil price cycles since then. Not as bad as the 70s, but nevertheless, they've been there. Oil's been at $100 a barrel before. We studied this back, and basically each cycle peak has about an 18-month time horizon in terms of impacts on inflation. The impact once it levels off fades over about 18 months. One of the risk factors that I've never thought of in my entire life is a global supply chain disruption, which is also going on simultaneously, having nothing to do with energy, actually, or in my opinion. So I'm less worried about the energy impact. Seems to have leveled off around 100 on WTI. If it doesn't go crazy higher, I think we just live through that. The two things that are bad, one thing you just brought up, is that what's always happened in the past, there's been a supply reaction to a great increase in oil prices, which does not seem to be happening. That's
not happening.
So that's on that count, that's the one thing that does work. The other side of it, how much do we divide the inflationary impact of energy prices, which affects everything that we do, with a supply chain disruption, which seems to impact most of the things that we do. And the supply chain disruption, in my view, there's no end in sight, at least not in the short run. Any comments?
Well, I think I'll start with the supply chain. I actually think we're seeing easing of supply chains, but you're getting new supply chain issues developing. So you had you had an Asia to the US supply chain problem that really, with the pandemic issue, now you have the worst supply chain issues that are rippling through the food system and energy system through Europe. So it's
and US. In the US.
Yeah, and it's worldwide, but the highest impact is really going to be in those areas, and it's creating different supply chain issues for those areas as they're redefining where they're going to get their energy sources from. I actually think we're getting closer to a peak in inflation pressures right now, and I think we're going to be leveling off and to start to see easing in the US. I don't think the rest of the world's going to get the same easing because of our energy production.
So we gave the same answers to Mark's survey.
Oh, we did? Okay. Then we're the two.
Supply chain seems to be one of the factors in the mix that we can be most confident that the capitalist system will solve.
Yes.
By itself. The other problems need policy revisions, new initiatives. The supply chain is driven by profitability all the way through, from top to bottom. And therefore, all the players in it are incented to fill the gaps, deliver products or services, and get it organized.
Except the governments, they're not
Right.
incented, and they're a big part of the problem because their policies, in some cases, are actually what's causing the supply chain issues.
Yeah, excellent point, and yes, major differentiation there.
So yeah, the left to its own devices, I believe that corporations and the private sector would solve the problem. But some of these supply chain issues started with tariffs and other issues going back further than that.
And the pandemic.
And the pandemic obviously was a big part of it. So this is the real challenge, I think, Andrew, to your question, which is you have two non-economic forces that are dominating the world economy today, and that is the pandemic and the war. And while we were hopeful that the pandemic was really getting closer to an end, the new variant seems to be spiking up again, and we might not be as close to the end as we thought we were. So that could prolong things a little bit too and make inflation a little bit more stubborn. But I think that different answers from leveling off versus declining, I think if we can get a leveling off, it allows us as investors to start coming up with valuations again that make sense, because you'll have a better sense of what inflation is, what interest rates are, so you can figure out better what your costs are going to be for businesses. But I do think this new wave of the pandemic, if not managed appropriately, could actually create another leg up if we're not careful. But I think in the US, we're being careful enough. Now, I don't know about, I worry about, again, the emerging economies where they didn't have the healthcare response that a more developed economy could, and getting their vaccines going. I think that's going to weigh on the system. And I think that's going to be a challenge for a while.
Hi, Stephen.
Hey,
Andrew
Steve.
Voss.
Andrew, yes.
Hey, nice to see you. Thanks as always. Historically, the U.S. is, with respect to the equity market, is often seen as a flight to safety when in the context of global turmoil, let's call it. Has that perception shifted, or will that be the case again going forward? Will it be enough to buoy the U.S. equity market?
I don't think the flight to the U.S. will be enough to buoy it. I think what changes the dynamic in equities is what I just said. You have to get to a peak in inflation and feel that that's peaking, and you have to know where interest rates are going to level off. And if you can figure out those two and the timing of it, you can see where the valuations are going to be in the market. And I think that's where you're going to see people really stepping up. But I think they're going to step up much more selectively. I think indexing, while it's an important element of portfolio strategy, I think that's going to be either reduced, and active is going to be much more of a focus as a result of that. But I think those two issues are going to drive, those will be the two big drivers, and those are driven by, the war and the pandemic. So I think you need to see some sort of finality to both, and I don't see them particularly soon, but it could be, I think inflation maybe a couple quarters out. We'll have to see. I do think the equity market, though, in the US has reached a level that is very investable right now, not the market, but companies in the market. I think you're looking at a 15 multiple on the market right now. And if you believe that we're around 3% rates is where we're going to be for a while, then that is typically, that's been a fine investment environment for a lot of periods in our past. So I don't see that as a particularly challenging issue.
Quick follow-up. The other looming big issue in the States, at least, has been this underfunded pension status and underfunded medical liabilities. And, you wonder where that all comes into play with the macro picture of everything you're laying out here.
Well, I think I'll let Bill jump in on the pension status, but I think last year actually filled the coffers up pretty well, and now they're being pulled back down again. So I think you're going to have to look out a couple of years before the pension bill comes due, but I'll pass it on to Bill. And we have a lot of pension people with us today, so I'll let them go.
So I'm hoarding in on Stephen's camera here, but it's an interesting question on the pension liability. Indeed, the last couple of years, pension funds in general have seen tremendous performance in their portfolios. Even the little one where I'm a trustee, we jumped several points on our funded status just on the basis of that performance, and we're up to like 85, 87% total funded. a number have done better. So the important thing to think about funded status is that it is done over long periods of time. So pensions have, essentially like 20 or 30 years in order to make that back. The shortest period of time that you kind of look at it is about a 5-year period, because that's where you smooth all the numbers and where you have ones dropping off and then ones picking up. So I think that it's, for certain localities, it is absolutely a crisis, but generally speaking, it's a lot better. The other aspect of that is interest rates, and having interest rates go up actually brings you have a smaller number of liabilities bringing forward, because you discount that at a higher rate. That has been a huge boon as far as the pension accounting is concerned. So in general, the pension funds are in a lot better shape just because of the market action, and, well, we would say the adverse move in rates has actually been a very beneficial move in rates for the pensions.
For their funding status long-term. In the
Exactly.
short term, they had to take the pain of, big losses on
That's right.
paper in
Yeah.
their portfolios. So you have the near-term pain for the longer-term benefit, because as Bill said, they look at it over a longer-term period for what their status is. And that kind of smooths out the problem that you have of market volatility that we're seeing today. So net, they're in okay shape. I think the issue that companies are going to have is, where does wage price spiral go? And I'm remiss in not mentioning my inflation outlook has some hope in it that we promptly resolve the railroad and port negotiations on their wage increases this summer, because if we go into a prolonged period, you'll have another spike up in inflation that would be unhealthy, to say the least.
Stephen, one comment on the pensions?
Yep.
I was an asset manager, we focused
Yep.
on pensions for 15 years. And you have to look at the reverse. Is one of the problems of underfunding is that the pensions have not been able to generate low risk interest rate income for a very long time now. As you commented, they're gonna have to take the pain of mark-to-market price and whatever they own today, but they've really been forced onto the equity side, which is much higher risk. What I've always said is, every time the equity markets go up, pensions should basically sell all their stocks if you're fully funded, and go to a fixed income alternative. And they haven't even had that option for a very long time now, and now they do.
Yep.
So I think, to your point, this is actually a good thing for pension funds, because they don't have to take the risk of let's say the market going down in a recession.
Yep.
They can balance their portfolios properly like they used to a long time ago.
Yep. I think the second part of your question, though, the shortfall in the Medicare and all that, it's just another part of the big bill that's going to come due for the US. And we got to get our healthcare costs down. And we had at our dinner last night, there was a fascinating young guy from the Harvard, I think, medical school, who is working on AI solutions for the healthcare sector. And I think you're going to see that will be one of the most attractive areas for capital flow to lower costs going forward. So it's not a surprise that was a big element of the survey. It's a big part of our investment thesis, is find the companies that are lowering healthcare costs for the world. You'll do fine with those names. And and you can buy them now. I don't think you have to wait. You'll have to deal with the short-term volatility, but I think value will out in the case of the really cost savers that are going to come to the healthcare system. They'll be the next Apples, I think.
Stephen, I'd like to offer an observation that has emerged during the.
See if I can get.
I'd rather not be identified, but during the course of this morning, if I'm going to be identified.
Okay, you really want to be identified?
I guess
Oh my
it's
God. Makeup.
It's the whole meeting, okay. During the course of the morning, in a program led by Bill, where we became enlightened beyond our expectations, there's been a lot of discussion, as there always is, of course, about the macro environment and the interaction of government policy and economics, and concerns about where's private equity and venture as well as publicly traded. securities. The observation I'd like to share and see if it stimulates any commentary is what we see in the limited context of the new 361 Ohio Technology Fund that we're in together. A number of others are in it with us, but we've got 30 some companies, all tech-based, mostly in the Midwest, revenues of, let's say, $1 to $4 million being pursued by companies that have revenues of, let's say, $30 to $50 million. And in looking only at that universe, we see very little evidence of any of the negative factors that are at play of impacting, of course, the public markets for sure. The only evidence is a diminished multiple of revenue consideration in cases where companies are in an industry that sells on that basis. But all technology-based, 6 different sectors within technology, and they're not affected. And I've been asking myself, what are some of the reasons that there's a universe way down there below where most of us think and operate, where innovation is happening, companies are being driven by inspired people that have goals, whether it's positive or out of fear, but goals, and they're growing rapidly and they're being acquired on a steady basis. So there's a world where things are okay. And I think the explanation, assuming that window it can be expanded to a larger universe of the same. I think what it says is it's just below the radar, and smaller companies buying other smaller companies way down the food chain can keep on trucking no matter what the world around them is like. Obviously, for companies that have large borrowing needs, they could be impacted by interest rates. But when you have small companies buying real small companies, that seems to not come into play. And it's a positive assessment of that zone at the moment, but it is different from the rest of the world. And it could say more broadly, apart from our specific fund, it could say that that's an area where investors should look a little more closely to find those companies that are going to survive, because there are a band of warriors driving an idea that's got to be tech-based, whether it's AI or others, because technology is what's going to alter the future and improve the larger conditions. And thus, I should end this observation in the mid-sentence, and therefore I just did.
Okay. With the mic drop.
By the way, what do you think?
I can only agree with you, Jack. Because to do anything else would be foolish at this point. I do think there's an element of the haves and have-nots that you're saying, and I think a lot of the companies we're looking at and that we like are in the haves category, and I think we're fortunate that I do think the funding need issue is a big determinant for the private and small cap companies right now. And the bill, if you need the money, it's hugely expensive and really a challenge. So
because your comment speaks to a definitional question. You said small cap. Well, what I'm talking about is
I mean small
talking
companies. I mean smaller companies in general.
right.
But I think the innovations is the answer. And if you can find the innovators that are solving real problems instead of searching for problems, I think that's where you'll see continued growth and continued money get attracted to it. I just think it's going to be harder to determine who's going to need the money coming up, who has the financial wherewithal to make it, and particularly when it's new technologies, you're not sure if they have the moat that they need. So I think you're in an environment where they look attractive relative to the others. It's harder to value, and but you're looking at the growth rates and you're solving problems. I think if you can solve problems, you'll do okay. If you're not, you're going to be in a bad way. And I think that's really one of the issues that you'll see. So I think that's the same thing. And there's a lot of mid-size and larger size companies that are really in nowhere's land right now. And I think those guys are going to be left on the side of the road for dead coming soon.
Even-
Is that,
1 second, Adam. It was a follow-up to Jack's question.
I'm the guy behind all the glasses on the table. Anyway, these companies, even the ones that are on the right track, given what's happened in the last 6 or 7 months, are they even going to be able to access financing to drive that process? Or has that changed or not changed since, let's say, a year ago?
Right. Well, if we break financing into two sectors, equity and debt, I believe that the answer on equity is there's substantial equity in the country through angel groups, institutional angel groups. That, to be unnecessarily precise, there are 260 organized institutional angel groups that collaborate closely in a subterranean world that most of us have little to no contact with. And then there are small venture capital funds that aren't the brand names that we're more familiar with, and they are all in positions of putting money to work. I mean, we just raised a fund in Cincinnati, a small angel fund that's double the largest fund of the past. And so I think there's that kind of money from I'll say non-institutional sources. You don't have pension funds necessarily dipping down that far into funds that are 10 or 20 or $30 million of committed capital, but you have other sources. So I think equity funding will be robust. Maybe there'll be some slicing and dicing of who merits getting it and who's not, but the supply won't go away.
Yeah.
Debt may be a different answer, because although there's such pressure now, mentality-wise, on getting to profitability, I mean, we see companies cutting here, cutting there in order to achieve profitability sooner. And by doing so, you got a bank. I mean, there's no problem getting a bank. In fact, banks are full of capital to loan to companies that are profitable. Banks are not in a position to put debt of any kind, mezz or just standard commercial debt, into companies that don't have a pretty good runway to profitability.
So the companies that, let's say, are innovative and successful, whether it's by profit or not profitable, to grow, and these are not, now we're past the angel stage, we're into the C round, or whatever you want to call it. Historically, those companies have not been funded by debt at that point,
Right.
Even ones that are profitable. That's been my experience. I think you probably agree. So the question then is, now you're looking at equity flows that need to be above and beyond angel investors, small venture funds. They have to be driven by institutional investors. There was an argument at dinner last night along these lines that the 1.4 trillion that's measured to be on the sidelines of private equity isn't actually there because it's all based on commitments, and the people that made those commitments won't actually be able to fulfill them. I don't know. This is what someone said at dinner. I have no corroboration. I don't know if anybody else does, but that means that money isn't really, it's phantom money. If that's true, I don't even know.
Yeah,
But anyway,
that might be an alcohol-induced assertion.
well, I wasn't drinking last night, so I don't know.
Not by you, but by the person who made the
No,
statement.
you were just the note taker and listener to other people. But if you look at the history of venture and private equity funding, the entities that don't deliver commitments, very small percentage. Now, maybe it'll be a higher percentage in today's world, but it's very small. And one of the reasons is people don't want to bail out because in most cases, you're nicked 50% or more of your interest. I mean, that's just standard operating procedures. So there are incentives to stay in the game unless you think the whole world's collapsing. And I don't think there's that much evidence within PE and VC that there are material changes occurring, even though we all live in an environment where we talk every day about the material changes that are surrounding us.
I think it's always comes back to valuation. This cash available, at what value will they be putting it to work? I think that's, I think the benefit of the 361 fund is it's a revenue generating fund already, as opposed to on the come, and you can attract capital to those companies. I think the ones with no revenue are going to have a much harder time attracting
Actually,
capital.
that's a helpful answer to your question, because what I have seen is trendy companies in hot areas that have peers that were commanding 10x revenue valuations now are saying 6, 8. So if valuations come down, but the company can still obtain the necessary capital to drive the business, then so what? You know, then it's a cap
Well,
table.
if you're an existing investor, I can tell you this, so what?
But if you're an existing, let's say you're an existing.
What are your
original
choices?
investor, you know, and you're gonna have substantial dilution or a write-off.
Yep.
You know, the choice is pretty easy.
Yes, it is.
And particularly with those founders that have large pieces of their company, thought they were gonna preserve them. And I just had a discussion with somebody, a founder, and had to tell them, you know, at the end of the day, you own 60% and you thought you'd stay above 50 and you're gonna end up at 30. Who cares? You know, build a substantial enterprise.
I have to switch gears and take a question from Adam. So Adam?
Stephen, the emerging markets have been dealing with debt burden for decades. And the way they've been dealing with that is depreciating the currency and interest rates and pegging to the dollar sometimes. Well, the reverse of that, yeah. My question is, the global deleverization that you're talking about, are you seeing a weakening demand for US sovereign debt or corporate debt?
No, the other way around. We are attracting, we are, you know, the prettiest girl at the ball right now when it comes to that. But I think the issue for these guys is the stronger the dollar gets, the more expensive that cost comes to them against a weakening economy. And it looks like a good deal going in, and it might not feel as good later on. So I think that's one of the challenges. I don't know if Greg, if you have a view on that, because you follow these numbers pretty closely.
Yeah, so on EM in particular, I think you're spot on, Stephen. I mean, it was a concern before COVID. It's a bigger concern after, because the prescriptions from the multilaterals, IMF, World Bank, and anybody you ask was stimulate, and worry about the bill later. And it's interesting because a lot of people said, yeah, there'll be a lot of debt forgiveness and all that, but every multilateral meeting and commission and group that's gotten together has not provided any meaningful debt relief to anybody, even to the countries that really need it the most. So that's a problem. The other thing, though, to consider is, while the crises rhyme, they're not always the same. Yeah. So after 2003, a lot of EMs moved to a lot more orthodox economics. And that included inflation targeting, and included trying to have less volatile currencies, and also development of local capital markets. So in the places where you've been able to do it, you have a much deeper local currency debt market, which then gives them the prerogative to solve some of the problems internally via inflating away or dealing internally with the topics. So those are some ameliorating considerations on the EM side, but the picture that Stephen paints is a bleak one. And for those that are dollar owers, dollar debtors, and do not have the ability to raise those dollars somehow. And I think one of your points, Adam, even though you didn't state it explicitly, is the capital markets drying up. Yes. It was fun to invest in an emerging market at a 3% yield when the yield in the United States was 0, or in Europe, or it was negative. And so that needs to be paid. Now, if you look at China, I mean, I think China's been mentioned, and China's ability to solve these problems or address these problems has been highlighted. They have a lot of abilities that democratic systems don't have. So remember, what these problems, they all get solved via a wealth transfer. Inflation is a wealth transfer. Debt forgiveness is a wealth transfer. So the big crisis that China solved in 99, 2000, when they recapitalized all the failing banks, was at the cost of the Chinese consumer. Consumption as a percentage of GDP in China dropped from a low 40, maybe 45% to arguably maybe in the high 20s. That's versus 70, 75% of the consumption being consumption of GDP in developed markets, especially the United States. And now they're dealing with another crisis, the one that stems from having highly stimulated the economy in 2008. That bill's coming due. That was done via fixed asset investment. And some fixed asset investment that has not produced the necessary cash flows to pay the debt. And so they're thinking about what to do again. And it may not be that easy to pass it on to the populace this time. They're getting a bit more restless. So you may have read about people who owe money on properties that they bought that are unfinished, but they're already paying the mortgage. Now they're not, they want to go on a strike and not pay. And so there's been one bank bailout and a lot of things in the works. So but yeah, it's a big mess. And the other one is the U.S. gets to export a lot of its problems away by being reserve currency, by being the largest economy, and at some point, people get fed up. And with a rising global power like China, like we didn't have in the previous 50 years of debt crisis, then the dynamics start to change a little bit. So those are really all things to talk about. I don't have a solution. I don't have the magic wand like Stephen, and so I don't know how it gets solved.
Greg, one of the points you brought up though is interesting because they're not all the same. But if you can stay in power like President Xi can, you can deal with longer term issues and create long-term solutions. If you're in Pakistan or Sri Lanka or some of these other countries, you got to stay in power. You got to stay in power to be able to affect the change. And new governments come in and they, redo everything and change policies, and you're back to where you were before. So some of the discipline that was put in place requires governments to be stable enough to allow the initiatives to work their way through. Usually, when you start with pain, the population gets pretty tired of it quick, and that's the problem with debt. The debt resolutions usually always involve pain. There's no resolution that doesn't involve pain unless it's a jubilee, and that'll involve pain for the guys who are the creditors, not the debtors. So I think that's the issue. But I do think you bring up an important point about you have to go and look at every country very differently for their specific problems and what their structure allows.
So there's a PhD thesis somewhere in what you said, right? Where the level of being able to solve these problems is inversely proportional to the degree of autocracy that you have.
Well, a former president here took that view. So
yes, completely agree.
Stephen, another question: prospects of recession, in your view?
There's about a 50% chance we're already in one, technically. I suspect that we will, I think we have a pretty good chance of slipping past one. The odds are right around 50, whether we go into one or not. I think if we have one, it'll be short and not very deep.
And what is it that allows us to slip past it?
The strength of our economy relative to everyone else. I think we are in our economic system. We talk, and I'm a big complainer about the way our government operates and all that, but I'm also a huge fan of the US system, and it starts with innovation. We have to do a better job on our education to keep the innovation up. We also have to change our immigration policy. It is so antiquated, and it's not the issues that the politicians are focused on. It's attracting and keeping the talent that comes to the United States for education. We got to keep it here instead of sending it back. Our H-1B visa policy is one of the most idiotic policies the US could have. We educate people, send them back to their countries because we won't give them an opportunity to stay here beyond, because we only keep something like 100,000 people. Canada lets in 300,000 to 400,000 H-1B visas a year, skilled labor basically, with a country of the 10th of the population of ours. You know, it's idiotic.
Two comments to add to that. Well,
Turn it
I
around.
got the glass out of my face. Just on the last thing is, I believe every PhD should come with a green card, but anyway, that's not what I.
That's a great idea.
It's not what I was gonna say. So, there's two things that we do that other countries either can or don't do. At least at the moment, we are exporting inflation. So we're not gonna suffer as bad as the rest of the world, even on that front. We're much more self-reliant on energy, so we're not gonna have technical shortages like Europe's going to. But the other thing that we do, you talked about innovation, it actually takes it a step further than that. We have no qualms about burying and destroying something that isn't working.
Mhm.
And other countries, and if you look at the banking crisis in 2008, 2009, whether we did it, I've got all kinds of things of how we could have done it better, but I'm not gonna get into that. But we did it. And the banking system was reconstituted relatively quickly. 2012, you could still go to Europe and and hedge funds were doing recap trades on banks 4 years later because they hadn't solved the problems and the banks stayed dysfunctional for a very long time. Our banking system is very strong right now. And it can weather the storm of a recession, in my opinion, quite easily.
The other thing is we have the deepest and most liquid capital market system in the world, and we take it for granted here every day. It is fascinating that how little regard we have for some of the great stuff our country has. So I'll stop there on the soapbox because I could go on this because I'm passionate about that part of it. And I can knock Washington all day, but
You know, that might be.
Even all of that is the foundation of the reserve currency. That's why it is a reserve currency, because of the confidence in the American system, the rule of law, the process. That's
And I'll
why
tell
we
you-
reserve currency.
yeah.
Where
and you
else do you have that?
And give our founding fathers a lot of credit. Those guys were wise beyond their, centuries, because they figured out that we needed checks and balances to avoid us from going down the path that other countries have. And so far we've managed to, although some people would question just how well we've skated past. But they really figured it out quite well.
As to those founding fathers, let's keep in mind that they had a group of even smarter women who
I'll need to
influenced
call
their
you back.
thinking process. And therefore, in light of those women and the role they played, and in light of how America is stronger than we generally think, which is the point you just made, let's at 4:00 today have a round of cocktails at Mark Sanor's expense to celebrate those two factors.
Amen to that.
Thank you,
I
Jack.
think Mark's not even on the call.
No, he came on and left a minute ago.
Listen, you don't have to be on the call to be the payor.